Morning and welcome to the Global Morning Call. Today is Wednesday, November the 30th, 2016, and we start with an update from our Asia desk with moltke-leth in Singapore.
Good morning, everybody. Thank you, Yasser. Yes, overnight concerns of fallout from Sunday's Italian referendum was eased a little bit by reports that ECB may step in and purchase Italian bonds should yields spike higher after the referendum. And this helped a rebound in the FTSE MIB, and we also saw Italian 10-year the yields on the 10-year bonds coming back by 12 basis points. Overnight, also seen very healthy economic data. We're seeing consumer sentiment and GDP painting a picture of an economy in very good condition. It's driven by a very robust consumer, and also house prices are now back at an all-time high in the US. We saw a very sharp lift in the Conference Board's Consumer Confidence Index, with present condition hitting as high as 130, and this actually points to a very healthy labor market at the moment. In Asia today, we didn't have any major data releases. The only thing of note really was Australian buildings approval that showed quite a big decline, and was a bit of a disappointment. We see the Aussie coming a bit lower after this today. Despite, I would say, very good news overnight on the U.S. economic front, we see momentum in a wide range of asset markets, including stocks, bonds, currencies, and metals coming lower. The momentum is still pretty bad. This is, of course, ahead of today's Opec meeting and the event risk on Sunday. The press conference is expected today at 4 p.m. CET. We could see some headlines around OPEC a bit earlier than that. But actually, of course, the headlines continue to hit the wires, and crude is down by 4% overnight. The pre-meeting headlines is showing there is still significant division between the main OPEC players. And also there is no commitment from non-OPEC important producers like Russia, non-OPEC members. So outside of the energy space, we also see significant weakness in the industrial metals. Copper and iron ore is selling off. There's a story out that China's regulator is curbing speculative flows into commodities in China. And this sends the Dalian iron ore futures contracts down by 8%, and we see BHP Billiton and Rio Tinto in Sydney selling off by more than 4% each. Also, Chinese regulators is out with more regulation today. The pace of depreciation in the Chinese yuan since Trump won has reduced the desire of Chinese policymakers to see funds freely leaving China. And now they're coming with a new regulation that only will allow cash to leave the country if it is for legitimate business reasons. This you could say this strong dollar environment is a pretty dangerous scenario for the UN, and we cannot rule out there will be a one-on-one or one-off devaluation coming pretty soon. John is not in today, so I have promised just to talk a little bit later on what's coming out today in Europe. We will see CPI report from France, and also the aggregate Euro area CPI. We will receive retail sales from Germany and Spain, and we have the November labor market data from Germany. In the US, we have the ADP labor market report, and this will give some additional indicators ahead of the very important employment data coming out on Friday. Of course, a 25 basis point Fed hike is fully priced in, but the question is if we get a really strong non-farm payroll, that the market could actually start tilting a bit towards 50 basis points. We'll have to see this. Today we also get personal incomes for October and spend and the retail spending, and This will help to refine the GDP estimates for Q4. Finally, we have the PMI for Chicago area, and this will actually fine-tune the estimates for tomorrow's ICM report. And with that being said, I will hand it over to the next speaker.
Thank you, Chris. So we'll run down of what's happening in Asia and on the macro side. So I think the overall theme we have here in equities is that we have stalled now in terms of momentum. It's pretty clear. We are range trading now in key markets. There's only a little bit of life in action in Japan and Chinese equities, and we are actually considering jumping on the bandwagon on Chinese equity through an ETF tracking the largest 50 stocks in China. I mean, you cannot ignore the momentum there, but obviously if we do it, I'll put it out on trading floor later today, and I will probably do it with a pretty tight stop. But it's just the momentum is so strong there that we cannot ignore it, and the strong dollar obviously will have positive effect on China's economy through the export sector. Also, the Italian referendum, we have talked a lot about it. Unfortunately, we cannot give a lot of color to our clients and you guys participating here in the morning call. It's on Sunday, and just know that we will have a gap risk on Monday. No polls are allowed in Italy because of how the law is structured. It's pretty clear that the Brexit and Trump event obviously is making the probability more than 50% that we'll probably get a no, because it will be a rejection of Renzi simply because he represents the establishment. That would be sort of the logic conclusion or bet. And if they vote no in Italy, we will probably could see a dramatic move in the euro and in financial stocks. Especially, there's a lot of focus on Italian banks. And we know that the largest bank in Italy, UniCredit, is out with a capital day on December the 13th, and they already now is pulling all the strings for a big capital raise of around 12 to 13 billion euros. It seems like they have commitment from investors, and that's prior to the referendum. So a very good strategy could be that if we get a no in the Italian referendum on Sunday, then Monday morning when UniCredit opens up lower, if it happens, it could be a buying opportunity, because if they get 12 to 13 billion euros, it should plug in that capital, that hole in the capital base, and make UniCredit in a much stronger position going forward. Talking banks again, we have Royal Bank of Scotland failing all stress tests, and they are now being forced by the regulators to cut costs further, and reducing their risk-weighted assets through disposal of key assets, and also shrinking their commercial loan portfolio pretty dramatically. So I mean, we're still in a very long journey here in financials with a lot of pain, and I think we'll go on in Europe for the next couple of years as well. Energy stocks, I've already said it multiple times, I'm not a favor of energy stocks, and I think the divide that we're seeing between Iran and Saudi Arabia is not a play for this world. I think it's pretty real and it's deep. And it really shows that OPEC is really losing control over this market. And if they even strike a deal and we get a pop in oil, it would be, in my view, an excellent shorting opportunity in energy stocks and energy stocks in general. As I showed you yesterday, the probability spread is negative among all the largest energy stocks. They cannot produce an attractive economic profit here, and that's even with oil prices at the current levels. Going back in 2002 and 2003. With oil price around $25 to $30 per barrel, they could easily make a much higher return. So it just shows you that the cost level in the energy companies has gone too far, and that the current levels is not sustainable. So they will have to either cut costs, cut wages, or hope for higher oil prices. But given what Iran and Saudi Arabia is discussing, it doesn't look like they can push the oil price higher through supply cuts. We're maintaining our short position in the DAX ahead of the Italian referendum on Sunday. As I said yesterday, we closed our Brazilian short position. And we bought a put on the S&P 500 as said yesterday. Also, again, I want to reiterate that the Japanese macro coming out overnight is still supporting our position in the Nikkei. As I said, it's where the action is right now, and I think it could continue. So, but I will end it here and give the word to Michael on Fit.
Thank you, Peter. And the news about the ECB set to be or allegedly preparing to step up its Italian bond buying if the referendum results causes a yield spike. Certainly rocked fixed income markets across Europe yesterday. The debate at the moment is whether they are actually allowed to do this within the existing framework, and this is what the report suggests they are. There is a chance, though, that it's just or more a matter of verbal intervention at this point, an idle threat, if you will. But it has seemed to work so far. Bunds has strengthened all the way up to or close to the 162 mark again. That's 20 basis points in yield terms. And if we look at the spread to both Italy and actually France as well, it narrowed quite a bit yesterday. We also had some very strong BTP Italian government bond auctions in both 5-year and 10-year yesterday. So that revealed a very strong underlying appetite for Italian debt. The Italian 10-year is down to 1.94%. Had its strongest day since March yesterday. So I think all in all, this reinforces the view that I talked about yesterday as well, that this is not really like the Brexit or Trump situations where everybody expected the extend and pretend outcome, so to speak. But in fact, it's actually difficult to find anyone who thinks this would be a yes vote, even though we are pretty sure that it's going to be a close outcome. So in case of a yes vote, that would obviously mean or be expected to give a massive positive reaction. And I think the no outcome, it might see a slight negative reaction, of course, but it is pretty much taken into account. And even if we see an initial reaction, as Peter talked about as well, we saw both in the case of Brexit and in the case of the Trump election that these immediate knee-jerk reactions, they actually turn out to be huge buying opportunities in terms of risk. So if we look at the credit, the corporate market also doing quite well. The iTraxx crossover at 340 basis points. Absolutely no stress there, except for some parts of the subordinated financial space, as Peter talked about as well. And also I would like to flag, obviously, the potential impact in the energy sector. We saw that earlier in the year, this year, a significant impact in the energy sector. Actually, also had some pretty serious impact on the wider market. So the Opec meeting today and a solution of that is certainly worth looking out for. That'll be the main thing here on the short term. And I will end it here. Leave you all to watch out for that. Thanks for tuning into the Saxo Daily Global Markets call this morning.